Hello everyone, welcome again to Hybrid Accounts. If you haven't subscribed, you can do that for regular updates. All right. Now, we're just trying to take the second look at the second method of computing cost of equity. It's part of cost of capital, apart from using the dividend growth model. Now we're on the CAPM, capital asset pricing model. For the dividend growth model, you can refer to the previous lectures. All right. Okay. What is the capital asset pricing model? What is it? When did it arise, and actually what is it used for? All right, capital asset pricing model is just a model that is constructed based on the market. All right, and it has several uses. The model can be used to calculate the cost of equity, for example, and it incorporates risk. We'll see how it incorporates risk, and this risk is usually called systematic risk. But don't worry about that. We're just going to take a look at it soon, very, very soon. It is usually based on the comparison of the systematic risk of individual investments with reference to the risk of all the shares in the market. Simply speaking, capital asset pricing model is pegged to the market, right? Okay, that's how we do it. So that's why it has several uses. It can be used to compute the cost of equity, but also it can be used to check for over or undervaluation of securities. You know, when you find out that the security is undervalued, you would want to buy more, let's say shares, you would want to buy more shares. And when you find that the security is overvalued and then you have them, you want to sell them so to gain something, all right? Yeah, so this is what is used here. So before just going directly to the cost of equity, we'll just take a look at what CAPM is, but also the associated factors. For example, we have something called portfolio theory. What is the portfolio theory? We learn the portfolio theory because we also need to learn the systematic risk. All right. A portfolio is simply a basket of securities. You have maybe two or more securities. You have put them together when investing, and then you say that you have formed a portfolio. All right. And so that's why we say investors can reduce the total risk on their investments through diversification. All right, into several actually uncorrelated securities. By saying uncorrelated securities, if you are blind about correlation analysis, you would find out that you can have negative correlation or very little positive correlation, something like that. And so if the more the correlations are, the more the securities are negatively related, the way the returns of the securities move in the opposite directions, the more you are likely to diversify away some risk, to eliminate some risk. So simply speaking, you diversify, you invest into different securities, expecting to reduce the risk, the overall risk of your portfolio, right? But usually not all risk can be removed, some risks remain. And so we say that a concept in portfolio theory are used in the capital asset pricing model in the market portfolio. By the market portfolio, we assume that let's say an investor, has decided to make a portfolio to set a basket of securities, which actually is just like a single portion, it's just like a sample of a total population, that population being the market. All right, so that's what we presume here. And so what's the market portfolio? It is simply a portfolio of investments, excluding risk-free investments. You know, when speaking of risk-free investments, it's like treasury bills or treasury bonds. When you have something like treasury bonds, you mean that actually the government cannot fail to pay you. So we just say that it has the minimum risk. It has a zero risk, and so we call the risk-free rate of return. When you lend something to the government won't fail to pay you. So we call the risk-free rate of return. So it's better before going to calculations directly, you get the total picture of what CAPM is, what portfolio theory is, right? Okay. Now we can proceed and say systematic risk and unsystematic risk. What is systematic risk, but also what is unsystematic risk? When speaking of systematic risk, actually, and systematic, it's when you have the total risk and you break it down into systematic and unsystematic. When speaking of unsystematic risk now, unsystematic risk is the risk that can be eliminated through diversification. You have invested into A shares, you have invested into B shares, into C shares. Maybe you have actually invested into share Z. Now, investing into several shares with uncorrelated returns, as I just showed you here, uncorrelated securities would lead to the overall reduction of the risk, right? Of course, for example, for CA students, you don't learn about risk and return, so I won't show much here. And so when speaking about systematic risk, is the risk specific to the entity that can be eliminated through diversification. That risk is not the market risk. It is for a specific entity. It is for the deficiencies of a specific entity or the nature of the way they operate. Okay, that's why we call it specific risk. But when speaking of systematic risk now, this one is due to the variations in the market. It is the market risk, and so it can usually not be eliminated through diversification. You can invest in a lot of shares in a lot of different securities, but still it would remain there. That is what we call systematic risk. Now, our main point here on systematic risk is how do we use it in the capital asset pricing model? Actually, when dealing with the capital asset pricing model assumptions, we usually presume that investors hold well-diversified portfolios. By holding well-diversified portfolios, we mean that unsystematic risk is totally eliminated and will remain with only systematic risk. So, investors may mix a diversified market portfolio with a risk-free assets actually to achieve a preferred mix of risk and return. And that this is what is used in the capital asset pricing model. Capital asset pricing model makes a combination of both risky and risk-free investments. And now we can proceed here on the capital asset pricing model. All right, now the capital asset pricing model uses a beta factor. This beta factor is used to measure the share volatility in terms of systematic risk. So simply speaking, that systematic risk is shown in the capital asset pricing model as a beta factor. All right. So in accordance with the portfolio theory, and systematic risk is ignored because we assume that the investors hold well-diversified portfolio to such an extent that there is no unsystematic risk. And so investors have to be compensated only for the systematic risk which they can themselves not eliminate, right? For unsystematic risk, we presume that they can eliminate it by themselves. All right. And so we assume that unsystematic risk can be diversified. All right. So we say that investors should only be compensated for systematic risk. I think I've said that already. Okay, now let's go to this beta factor because it is used in the capital asset pricing model. What is the beta factor? As we said here, it is just a factor that is a measure of systematic risk of a security relative to the market. All right, the market beta factor is usually equal to 1. Market beta factor equals to 1. So if you have a beta factor greater than 1, it means that your returns of your securities are more volatile. If beta is less than 1, we mean that they are less volatile compared to the market. All right. So we say generally, the higher the beta factor, that means the higher the systematic risk, the more volatile its returns. That means the more the risk in response to the factors that affect market returns. All right, now let's go to the CAPM formula. The following is the formula for CAPM, and this is what you need should it come to the matter of determining cost of equity. So capital asset pricing model formula is like this. This one is the return on the security. And for cost of equity, we usually call it cost of equity. So this is the formula for cost of equity equals to RF, which is risk-free rate of return, plus beta. If it's equity, this one will be equity beta, then times equity risk premium, which is the difference between the return on market and the risk-free rate of return. That's why we define each term down here. So RI means the return on a security or portfolio. Most of the time they deal with securities, but it could be a portfolio, no problem. RF equals to the risk-free rate of return. By saying the risk-free rate of return, it means that it is the return that you are guaranteed. You cannot say that, oh, I lent my money to someone, he cannot pay me. No. We usually refer to this as the actually company, let's say the countries. The countries issue treasury bills, for example, or government bills. If they issue the bills, we believe that the country will never be able to pay us. It will be just a matter of time. So this risk, you are paid for this risk-free rate of return just for time value of money, just for giving them, you lend them today, maybe they pay you after 1 year, just for waiting that time. They compensate you for the time, not for the risk that they will fail to compensate you, right? And then we have RM, the return from the market. And then we have the beta. This is the beta factor or systematic risk over security with reference to the market. And so the same formula can be used to obtain the cost of equity. So simply speaking, cost of equity equals to RF plus beta brackets RM minus RF, where BI equals to the equity beta. Now, don't worry about that. We'll see about equity beta, asset beta, as well as debt beta, but not in this section. We'll see it after this, right? Okay, so this is what you need to know to obtain the cost of equity. All right, I think we have gone a lot further, and so we can proceed with the capital asset pricing model, just like this one. Now, here is the plot. You can plot the graph of return on market. You can plot the graph of return on the security against the risk, which is the market risk. You would have the y-axis, you would have the x-axis, and then you would have the return on the security, and here you would have the systematic risk, which is the beta. All right, after that, you can draw the graph like this. If you just take a look at here, this wouldn't be so difficult to spot. You know, this cost of equity is the return that we seek. So it is y. This beta is the x-axis, and now here, this is the y-intercept. This is the y-intercept. It is the value of the return when the beta is 0. If you put beta 0 here, we say this value should be equal to return risk-free rate of return, which is the RF. So here stays RF. But also now you can just say, oh, what is the slope? Slope is the change in x, change in y over change in x. The slope would be this figure here, Rm minus Rf, which is the equity risk premium, which is the difference between return on market and the risk-free rate of return, guys. Okay, now let's say that in the exam you were asked to explain the CAPM elements. What are the CAPM elements? Capital asset pricing model has 3 major elements. The first one is here, risk-free rate of return. So it is the return with the totally no risk. It's totally no risk. We mean that only the passage of time is required. So if any risk, we would call it the passage of time. Just wait and you would have your money. You have lent us, just wait and you have your money. It's guaranteed. It's just a matter of time, right? And then you would have this beta, which you call the systematic risk, all right? And then you would have this one, Rm minus Rf, which we call the risk premium, okay? And you say this is the excess of the market rate of return over the risk-free rate of return. So those are the components of the capital asset pricing model. And now let's go and take a look at the assumptions. You know, capital asset pricing model doesn't just come as it is. It comes with its assumptions. There are assumptions made when dealing with the capital asset pricing model. The first one, we say that investors hold well-diversified portfolios. I think I've explained this already. If investors hold well-diversified portfolios, we mean that unsystematic risk will totally be eliminated, and so we would remain with only systematic risk. And that's why even in the formula, we use that beta, and beta is the measure of systematic risk only. Second, there is a perfect capital market. By saying a perfect capital market, actually, we have a lot to speak of here. That all securities are valued correctly and their returns plot on the security market line. The figure that I just showed above, that graph was called, you can also call it a security market line, all right? So we mean by saying a perfect capital market, we mean that there is no taxation, no tax, but we also mean there is no transaction costs. Let's say when you are buying securities or selling securities, no transaction costs like issue cost of issue, they're not involved there at all. And then we say there is perfect information that is freely available. You know, you can enter a market and then you can buy something for a much high price just because you didn't have sufficient information on that it can be purchased at a lower price. So here, we presume that there is perfect information. All information necessary and needed actually is contained by every investor. But also we say all investors are risk averse and rational. So all investors act in a rational way. Now, don't be confused here. By saying risk averse, it doesn't mean that you do not have, you just don't need a risk. No, you can also be ready to incur more risk if you earn more return. That one is also included, because you cannot say that, oh, since I'm risk averse, I just need something with little risk. No, it's not like that. But also we say that there is a large number of buyers and sellers in the market, so that when you need to buy something or to sell something, you can obtain it. It's readily available. All right. In an exam, you can just put this point as separate. Number 3, we say that there can be unrestricted borrowing or lending at the risk-free rate of interest. This one is another assumption which is usually not so relevant. You know, Unrestricted borrowing and lending. Whenever you need to borrow or you need to lend, actually you can do that at the risk-free rate of interest. That means at the minimum rate. Okay. And then, but usually, as I just showed you, this can be maybe true, maybe for governments, just like that. But also say all forecasts are made in the context of a single time horizon. Simply speaking, capital asset pricing model is a single period model. It's a model that is based on the single period, usually 1 year, maybe for comparison, you can just use a single year. Now, in an exam, you can also be told to speak of the capital asset pricing model limitations. These limitations are actually derived from these assumptions because most assumptions actually are not actually very true, or they can be somehow, but they cannot be perfect. Okay. Number one, we say investors may not hold well-diversified portfolios, so it's just a negation of this point number one. But number two, we say that in practice, there is no a perfect capital market. Having a market with no taxation is difficult, so probably there will be taxation, there will be transaction cost, there will be some kind of imperfect information. All right, not all investors would be risk averse, something like that. Right, so those are just examples. That's why we say there will be things like taxes, transaction cost, imperfect information, and the like. But another point to say, borrowing and or lending at the risk-free rate is not always possible. You know, this is maybe general for companies. I mean, for countries, let's say. For example, if the country borrows from you, actually, you are almost sure that they will pay you back. So you say that there is no risk. It's just a matter of waiting and you will have your money. Something like that, then you can say it is not possible to obtain the variables for unlisted companies. Let's say you need the beta. How do you obtain the equity beta or asset beta? That beta factor, that's systematic risk. For the company that is not listed, it's very difficult to obtain that, or it may not be possible. It may not be possible. And then we say historical data used may not be relevant. You might be using the beta, the systematic risk for previous, maybe which let's say 2 months, 3 months have passed and you're still using it. It may not be relevant. It may just reflect the past. So now we are just fine. We could just go to an example and see how capital asset pricing model works out in determining the cost of equity. Now the question, equity of a company has a systematic risk of 1.2. So this is equity beta. And if the market rate of return is 12% and the treasury bill rate is 5%, determine the cost of equity. Let's go to the solution here. And then you have the data. First of all, we need the cost of equity, which equals to RF, risk rate of return, plus equity beta times the market risk premium. So we are given from the question equity beta equals 1.2. We are given the market rate, which is 12%, and this treasury rate is the risk-free rate of return, which is 5%. So just plug in the numbers and everything will be fine. So I have the risk-free rate of return. I have the beta here, 1.2. I have RM, market return, 12%, and RF, 5%. 12 minus 5 equals 7%. 7 times 1.2, 8.4, 8.4 plus 5, I would have the cost of equity at 13.4, and everything would be fine. Now let's go to example 2 here. We are told the equity of a company has a systematic risk of 1.1, and then a dividend of $1 per share is to be paid. If the market price per share is $17, but was $16 at the start of the year, and the treasury bill rate is 4%, determine the cost of equity. How do you go about this now? We do the same, exactly the same. You just say this is the formula for cost of equity, and then you take the data that you have. Now from the question, you have the systematic risk of 1.1. You need the market return, but actually did not have it. Now you have to note one thing here. I think it's time that I make a bit of an illustration right here, all right? Okay, now just take a look at what I'm just about to put here. Now, you know, when you need to know the return, you need to get the return. Return is usually comprised of two matters. For example, when you are dealing with shares, you can have something from dividend, which we call dividend yield, but also you can have something from the shares increase, you know, the increase of shares, which you call capital gain. Capital gain. But if you say the word yield, that means you divide by the number of shares. you divide by the price, sorry. So to obtain the return now, you check just the question. We said that the dividend of 1 is to be paid, dividend of $1 per share. The new price, the current price is 17, but at the beginning it was 16. So divide by the original price. So I would say dividend 1, D1, all right, over original price at that price at the start, which is P0 plus capital gain equals to the difference between the share increase, so P increase or decrease, whatever. P1 minus P0 over P0, something like this. And if you do this, actually, you'll be in a better position to proceed. So I will just say, oh, so it's just like this. My dividend per share equals to 1 over price, that is 16. Then I would add something like this. Then P1 17 minus P0, which is 16 divided by 16 again. If you do this and everything goes well, you'll arrive with 12.5%. All right. So just get the value multiplied by 100% and you'll arrive at 12%. So that's what actually happened over here. So you just get it like this, and then you proceed with the question that you are given the risk-free rate of return, which is the treasury bill rate is 4%, and then plug it into the formula. You have the RF 5%, you have the beta 1.1, and you have the return on market 12.5% minus 4% is the risk-free rate. And doing that would arrive at the cost of equity of 14.35. So that will be all about determining the cost of equity. Now you have to note one thing. Let me just give you a caution. Let me caution you here. Caution. So be careful about what I'm just about to speak of. You know, you can be given the equity risk premium. If you are given the equity risk premium, that means you already have RM minus RF. So just plug it directly into the solution, into the solution, right? Do not waste your time. For example, let's say you are given the equity risk premium, let's say equals to 8%. This one is given, obviously. 8%, I mean 8%, just like this. And then you are told the risk-free rate of return is, say, 3%. And maybe you're also given the beta factor. Systematic risk is beta, and this one equals to, let's say, it's 1.2, just like that. If you need to obtain the cost of equity, you just plug your values. RF, which is 3%. So I would say 3% over there. I would add beta equals to 1.2. Now, times the equity risk premium. We already have the equity risk premium, right? You already have it. So you do not have to take RM minus something. You already have it as 8%. So I say times 8%, and I arrive at how much? 1.2 times 8 equals 9.6, plus 3 would be 12.6, and everything would be fine. And so up to here, actually, CAPM is done. But all I need us to do is just let's go and explore more about this beta factor. You know, you have just studied, but you haven't dealt well with beta factor. So